welcome to your real estate tips for buyers and sellers. I'm Dolly Torres, real estate broker and mortgage broker in the state of Florida and Kentucky. And today I am joined by David. Welcome back, David. How are you?
I'm doing well. Yourself?
I'm doing great. Thank you for joining me one more time. I wanted to
Oh,
talk to you about bank statement loans. What is a bank statement loan? Why are they so popular nowadays? And what people need to know about them. So let's start with the first.
okay.
What is a bank statement loan?
Well, the bank statement is basically an alternative form of verifying your income. I mean, we're actually at the perfect time if you think about it, because tax filings were due this week. Well, a good percentage of those self-employed borrowers who filed their taxes, their true income may be slightly different. They've been able to take advantage of all the tax write-offs and so forth within their tax returns, but that's great for paying income taxes, but it can be detrimental for qualifying for a loan. So
Right.
we understand that their true income is actually higher than what their taxable income may be showing. So the bank statement program gives them the alternative to verify their income based on the deposits into their business or personal accounts over a 12 or 24-month period.
Perfect. And well, now I feel like we are doing more bank statement loans that we have done in the past. And I believe it's just because of what you said. There's a lot of us who own businesses. We
Exactly.
try to write everything that we legally can. And in that, while doing so, our net income kind of reduces tremendously. So while using bank statement loans, there's, as you said, another alternative to get the real and actual income. So how is that income calculated?
Well, it can be calculated a couple different ways. So we have both the 12 and the 24-month bank statement. We do allow, there are some of our competitors out there that, although they do bank statements, they can only allow either personal or business, and very few, if any, allow commingled funds, which is utilizing both. They want you to pick one account and that's all you can use. But we understand that's not practical. Depending on your business, there are times where people may Zelle your personal, but deposit into your business. So we should have the ability, and our customers should have the ability to use that flexibility. So again, we could either use the most recent 12 months. There are times where we can also go up to 24 months. I mean, it's actually at your discretion. The reasons to go 24 months, I mean, it's a little bit more labor intensive just because everyone has to collect 12 more, and there's more things to look at that point. Like God forbid they have overdrafts or NSFs, you're only allowed a certain number within 12 months. So if they go 24 months, there's just a bigger window to potentially see a hiccup there. But if you have somebody, realtors, for example, there's some seasonality to their income. Well, if we're in kind of a down season, we might look at as declining income. But if we get 24 months, we just show, no, it's the seasonality. It's hurricane season. We aren't going to be selling. So it's, so in that aspect, we could take a full true average at that point.
That's great. So normally what potential borrowers that we need to do is just collect their 12 months or 24 months bank statements and actually send it into to your loan officer. And then from that loan officer, we'll go to David if they work with NewFi Wholesales. And they will calculate their income based on those deposits. Not necessarily transfers, but actual deposits that have come into the account. Am I accurate on that?
That is correct. So we cannot use deposits from account to account, so borrower's account to a borrower's account.
Yep, transfers.
We can use transfers because we do run into situations where some independent contractors or so forth may have clients who utilize the same banks. So if the customer utilizes Bank of America and our client uses Bank of America, we may see a transfer from a Bank of America account into our borrower's account. We just have to then identify that they aren't owned by the same client at that point. So those we can use, but you are correct, Dolly. We would take an average of the 24 months, or the 12 months, I should say, deposits. So each month we'd add up the deposits. We would exclude anything that's not income, which would be a transfer, like you said. But also this time of year, sometimes we'll see a tax refund. That's technically not deposit. I mean, income, true income. So a tax refund, we'd exclude that out. Or a sale of property, automobile, something that we would exclude. But we'd add those up. We then have to take an expense factor. Our default expense factor is 50%, but we are not limited to 50%. So if you have somebody that has a lot of gross deposits and they can just easily manage the 50% expense rate, that's path of least resistance. That's how we'd go. But if their truer net income and expense rate is lower, then at that point, we can drop that all the way down to a floor of 10%, just with a CPA letter or a licensed tax preparer that basically states in their letter that they understand and have worked with this borrower, and this is their true and accurate or more realistic expense factor is 15% or whatever it may be.
Got it. Okay. So this program, I felt like it's ideal for those business owners or people that have a lot of deposits and income due to business, but not necessarily shows on their tax returns. Now, if someone is watching this video and they want to apply for a bank statement loan, what would be the criteria as far as NewFi Wholesale Mortgages require as far as credit score or the down payment? Do we run DU at that point?
We do
What
not
what
run D. Well, okay, we do not run an AUS. We do not run DU on these programs. That said, we can run DU to overcome a certain condition. So, for example, if they have a mortgage that isn't appearing, or there's spots in appearing it on their credit report, and we can't get a full 12 months for whatever reason. If you were to run a DU and get an approved eligible or an approved ineligible, we would use that to clear the housing history condition. So that would be the only case time in which we would run a US or a DU. But other than that, no, you don't have to run it. We can actually, on a bank statement program, can go up to 90% loan to value. So basically 10% down. I can tell you the sweet spot usually is that 20% down when it comes to, from a qualifying perspective, you can go at a 720, you can go 90%. At a 700, you can go 85% or 15% down. And then a 680 or 660, you can go 80%. So that meets the criteria pretty quickly. But we go down to 660 on our standard program, but we can go down as low as a 620 on our expanded bank statement program. That would just end up, they would have to bring in 25% down.
Got it. Okay. And then, so what would you kind of, what are the biggest highlight that you really want the viewers to know about this program, and why would they choose a bank statement loan versus a DSCR loan, or versus a CPA letter, other programs that we have spoken about? What does this one make special versus the other?
Okay, so with regards to the DSCR loan that you mentioned, that would be strictly for investment property, for rentals. With the bank statement loan, you can do that for owner-occupied second home or investment property. So there are times where it might be more advantageous from either a pricing perspective or a qualifying perspective to do the bank statement on an investment. For example, if the DSCR the market rents don't quite support, for whatever reason, the cash flowing of the property, then the bank statement would be an alternative for it. So you have different avenues. I think what we talked about before in some of the earlier podcasts is just the great thing about NewFi is our flexibility. If we can't get it fit into one bucket, we usually have 2 or 3 other buckets that we have to choose from, that we can find your borrowers the best solution to get into their homes. But
David,
I would,
go ahead.
oh no, I
No.
was just going to say, if you have a self-employed borrower, the first thing I would determine is how do they receive their income. If it's 1099, then you may want to go that. We may want to look at the 1099 program route. So if it's a Uber driver, gig driver, independent consultant, or contractor, that gives you an alternative. And the only reason I would say the 1099 is the default expense rate on the 1099 is 10%, where on bank statements it's 50%. But the average would be, if you have a self-employed person, do your taxes show your income? More than likely, you're like everybody else, and you take advantage of the tax laws and to the maximum benefit. But we still want to qualify you. Do you deposit your earnings? If you do that, then let's get 12. I would suggest getting 24 bank statements, and let's determine which is better. I can calculate the income for you, like we do, Dolly, and we may decide, okay, we got 24. Let's just use the last 12. But at least it's better to ask up front to get the full 24 and then only use half of it, than to get the 12 and then have to go back and ask more if we need it.
Got it. Makes sense. David, let's say, because you're a wholesaler, right?
Right.
And so people cannot really contact you directly other than loan officers. But if
Right.
someone needs, they just are in whichever state and they're just looking at us,
Mhm.
and they contact their loan officer that they know, or someone
Right.
referred them to them, but they really want to work with NewFi, and they don't have a connection with NewFi yet. Oh, I can't talk. So with NewFi, they
Right.
don't have a connection yet. So how do they do that connection with you so they can ensure to get the program? Because there's different bank statements, guys. As a loan officer myself, we work with different lenders. And even though some of them have, similar products or the same products, just the way that they structure things, the process itself, the pricing, the criteria might be a little different. So if someone really wants to work with you through a loan officer, obviously, how is the process to get connected with you? I know you can call me and I can definitely help, but I only
Right.
work in Florida and Kentucky. So, if you're in Ohio, for example, or Maryland,
Mhm.
how can they connect with you?
Well, I mean, they could feel free to email me directly. It's dseaton, Seaton, at newfi.com. And I can either direct them to a local broker that works with us, that it can help them feed that way. If not, we do have a very small, intimate, direct-to-consumer. We are primarily a wholesale lender. That's our bread and butter, and we love that relationship. But we do have the ability, and if who's hearing this doesn't currently have a loan officer, by all means, feel free to reach out to me, because we can find somebody for you that is currently licensed in that state and working with us and knows our programs, and we can speak directly with them for you.
Awesome. David, once again, thank you so much for joining me today and kind of going over the bank statement program that it has been very, very popular lately. So once again, thank you guys at home. Thank you for watching, and I'll see you guys next week. Bye-bye.
Perfect.
Thank you.